So let's focus on the balance sheet. And remember, the purpose of the balance sheet is to give us, assets equals liabilities plus shareholders' equity. So it's proving the accounting equation. And basically what it's doing is it's giving us the financial position of the company. And this is important as of a particular date. So the balance sheet is the only financial statement that you're going to see that just has a specific date. So it's really just giving us a snapshot of the business as of a particular date in time. So it's giving us the assets that the company owns and how those assets were financed. Were they financed with debt or equity? The balance sheet is usually classified or grouped according to common characteristics. And so you'll see things under assets, for example, you'll see current assets. And then under liabilities, you'll see current liabilities and long-term liabilities. So we're grouping them based on the characteristic of, for example, for assets, how quickly we could convert those to cash or use them up. Current assets are listed in order of liquidity. And remember that liquidity means how quickly we can convert them to cash or use them up. So for example, under current assets, we would see, of course, cash listed first because it's the most liquid. And then below that, we might see some short-term marketable securities. And again, so it's things that are most liquid would be listed first. So the balance sheet does have some limitations. I want to kind of get into that. So, it's like any of the financial statements. If you're only looking at one statement, you're really not going to get the whole picture of the company. So it's only looking at assets, liabilities, and equities. So that's one limitation, and all of them have that same limitation. But the balance sheet has some additional limitations as well. So one of the things that is one of the greatest limitations is that the book value, which is assets minus liabilities, may not directly measure the market value of the company. And that's because there are some things that may be an asset. It may create value for the company, but it is not going to get recorded as an asset on the balance sheet. So things like that would represent valuable resources might be like a particular expertise that our group of engineers has, for example. We're not going to record that as an asset on the balance sheet, but it could create value and enhance the market value of our particular company. The other thing is that most of the assets are going to be recorded at their historical cost rather than fair values. And so the assumption here is that if I'm willing to pay X number of dollars for an asset and somebody is willing to sell it to me for that same price, then that must be its value. And so if we get a particularly good deal on an asset, it still gets recorded at that historical cost, what we paid for it. So historical cost is what we paid for it. And so it's going to get recorded at that price regardless of whether that really is its fair value.